Okay, the meeting is now streaming. As Commissioner Getz, he called the meeting to order at 3:06. And for our first item on the presentation, we have Terry and John here from PNC to review the PNC performance presentation. And hopefully we don't go through all 112 pages and just go through the highlights.
If I could, before you start with PNC, just because we are live, I just will like to say that besides myself, Jim Getz as chair, along with Craig Sherman, CFO of the Park Board, we have our investment committee members, Steve Pullman, John Nyer, and Kevin. Oh, I am on vacation here.
Kevin Margarita.
So we have, yeah, exactly. So with that, we will turn it over to PNC.
All right. Well, thank you very much, Craig and Jim and committee. Again, I'm Terry Allman, a senior investment advisor with PNC, and joining me and who'll be speaking here soon is John Camello, who is our regional investment director, but resides here in Cincinnati and has been part of the portfolio management team for a while now. First question, thanks again for having us. I know you've got other items on your agenda today. How long are you comfortable with us taking of the agenda?
Well, I think if we could focus, I don't want to cut you short on this, so I would like to keep it within 20 minutes, but I think the key focus, I know all of us have been on some calls prior to this as far as looking at historic market performance and that sort of thing. So if we could keep it focused on our PNC investments and perhaps discussions on how we can improve the returns going forward, that'd be perfect.
Okay, we can do that. Everyone has the packet that was sent out yesterday, so I won't be presenting on screen, but we will hit. First thing I just wanted to mention, we've been trying to just make sure our clients are aware that we have redoubled our diversity and inclusion efforts. Really over the last 9 months to a year, given in the wake of the death of George Floyd and protests that occurred over the summer of 2020, we realized although we've actually received quite a few awards and accolades for our efforts in the diversity and inclusion sphere, there's just so much more that needs to be done, and things weren't quite moving fast enough, and so we have redoubled efforts in the diversity and inclusion area, specifically committed $1 billion to helping to end systemic racism and support economic empowerment, and that's being pushed through all markets within the PNC sphere, pretty directly to minority-owned businesses, et cetera. We've created our first chief responsibility officer role that reports directly to our CEO. And the goal there is to make sure that this is part of our everyday conversation within the bank and not just something that we look at quarterly, annually, that type of thing. And to that point, we've had daily conversations across the bank and within business lines and in markets around these items. We also have appointed our first 2 Black executive committee members, including John and I's ultimate boss, Carol Brown, who heads the asset management group at PNC, which is roughly a third of the bank. Wanted to make you aware of those. And with that, I'm going to move to
Mr.
our capital.
Chair, if I could at this point,
yes.
just ask a question of Terry.
Yeah.
Terry, I see your commitment to ethnic and racial diversity, and I see commitment to women's leadership. I see your employee business resource groups. I don't see much of a commitment to persons with disabilities. I see that you've scored well on something that I have never heard of, but what is your commitment? Everybody talks about diversity, and the demographic that has the highest unemployment has the least investment in owned businesses are persons with disabilities. And yet we never hear about that. Is it that we need to protest more? Is it that we need to march in the streets or roll in the streets, and then PNC will start paying attention to people with disabilities? Why is it that large companies, when they talk about diversity, only talk about Black-owned businesses and women-owned businesses?
You know, Kevin, it's a fantastic question that unfortunately I don't have the answer to.
No one does.
Yeah. You know, interesting. I was trying to remember. I actually had a conversation with a client last week, a nonprofit here locally that really focuses on assisting people with disabilities live independently. And you know, I'm surprised I didn't get called out on that a little bit in that conversation, to be honest. And wish I had been, so I could be better prepared to answer your question today. But
that must be
is
one of the few boards that I'm not on, because I would have called you out on it.
Well, it was really just a conversation with the executive director, so you may be on the board. But you know, I'll take that back. And it's such a good question, and we now have very good lines of communication. So I'll get that question answered and follow up with you if you don't mind.
I appreciate that, Terry, and trust me, this is not meant to single out PNC.
No, I completely understand, and you know, it's such a obvious and straightforward question. I'm a little stunned I don't have a better answer. But we'll
let you continue with your presentation.
Okay. Well, thank you. And I will let John kind of highlight from a capital markets perspective what we really saw in 2020 that impacted specifically our performance, but really performance across the markets. And then we'll hit how that specifically impacted the portfolios, as well as talk about some coming changes to the investment policy that Craig and I have worked on in the last couple of weeks, and we'll be implementing soon, and should put us more aligned with certainly the other managers on the platform. So John, I'll let you take over.
Great. Thank you, Terry. Good afternoon, everyone. Can you hear me okay?
Yes, thank you.
Okay. Well, as you had noted at the beginning of the presentation, we have a lot of information packed in to the presentation overall. I will try to go over the capital market information fairly succinctly, but please, if you do have questions, please interrupt. So what I would like to do is just start today's conversation on page 8. And while, as Terry had mentioned, you know, the performance information or the data that we have in the presentation today is as of the end of February, we did want to take this opportunity just to discuss some of the performance outliers that occurred over the course of 2020, due in part to the pandemic, and essentially how some of those outliers really served as headwinds for our portfolio, primarily, I'd note, on the domestic equity side. So on page 8, really just note that, you know, it's kind of a tale of two extremes from a market performance perspective over the course of 2020. You had the pandemic-induced correction, which occurred in Q1, and that was followed by a recovery in risk-based assets over the subsequent 3 quarters, supported to a large extent by just massive amounts of fiscal and monetary stimulus. From an equity market perspective, as noted on page 8, There were a handful of outliers that really drove market performance over 2020. And again, it served as somewhat of a headwind for our positioning, in particular at the beginning of the year. So for the first 3 quarters of 2020, market performance was very concentrated, just in a handful of names in a few sectors. So primarily the 5 largest names within the S&P 500 and 3 of the 11 sectors of the S&P really drove returns over those first 3 quarters. We saw a little bit of a reversal of that in Q4 as, word of the vaccine on the horizon, as well as additional fiscal stimulus on the way, really helped add to the depth and breadth of market participation in Q4. And we've enjoyed some of that so far this year. But it was really a struggle and very concentrated over the first 3 quarters. Another outlier that also occurred was just we saw non-earning companies had outsized returns over the course of the year. Given the types of underlying investment managers that we have in our portfolio, they tend to be a little bit more quality oriented. They base their investment decisions on underlying fundamentals. Our exposure to some of the we would perceive to be as lower quality, non-earning type companies that were already trading at stretched valuations, we really didn't have a whole lot of exposure to those names within our portfolio, and that in and of itself also served as a headwind on the equity side. From a fixed income perspective, it was kind of again a story of 2 halves. Pre and post Fed intervention. During Q1, credit markets sold off given concerns associated with the pandemic. Treasuries, in particular, longer term or longer duration treasuries, did quite well in that environment. After the Fed intervened and stepped in to stabilize lending markets in general, we saw financial conditions really improve, and what we would say corporate or credit type sectors or spread type sectors did exceptionally well over the remaining 3 quarters. So our positioning at the beginning of the year kind of hurt us on the fixed income side, but maintaining that same position throughout the course of the year helped our fixed income returns, and you'll see that reflected in our numbers. In the interest of time, I'm going to just touch on a couple of these other pages. I think page 10 is worth noting. Just to, again, highlight some of the nuances over the course of 2020. So if you look at the colorful graph that's represented on page 10, you'll note the far right-hand column really represents how different asset classes over the course of 2020 performed. And you'll notice at the top of that, large cap growth dominated pretty much any other asset class, both from an equity and a fixed income and even an alternative perspective over the course of 2020. And again, we'll look at some additional slides that show the concentrated nature of that. But we saw significant disparity, not only between just how large cap growth performed, being up 33.5% relative to the second best asset class, small cap, which was up 20%, which is still obviously very good. But we saw a huge divide between just how domestic large cap growth did at 33.5% and how domestic large cap value did. So at the second box from the bottom would represent how domestic large cap value did. It was up only 1.4% relative to large cap growth, which was up again 33.5%. We've really never seen that big of a divide of essentially roughly 32% between those 2 asset classes. Interesting also to note is, if you look at 2019, large cap value was actually the best performing asset class last year, significant reversal of fortunes over the course of 2020. And then also something to note that you may pick up in some of the accompanying slides, small cap in general, while it was up 20% for the full year, it was actually down 10% going into the 4th quarter. So significant rally in small cap and mid cap stocks that we enjoyed over Q4. Briefly, I will turn your attention to let's see here, slide 13. I think this probably captures some of the nuances of the concentrated movement on the equity side best relative to some of the earlier slides. So what we noticed on the left-hand side of that page, you get an appreciation of the contribution of individual stocks over the first 3 quarters, the fourth quarter, and then full year 2020. And what we found was the largest 5 companies in the S&P 500, which are, tend to be referred to as the FANG plus Microsoft companies. Over the first quarters of the year, they were up 8.9%. The index, while the other 495 companies within that index were actually down 0.3%. So our positioning coming into the year and having a little bit more of a value orientation and an underweight to large cap growth was one of the headwinds that hit us early on in the year and put us in a position where we needed to recover over the course of the year. Again, we saw a little bit of a reversal of that in Q4, but not enough to offset some of our positioning early on. Over the course of the calendar year 2020, you can see again in that column that we did see other stocks start to participate in the latter portion of the year, but again, the movement of those 5 stocks really drove a good portion of market return for the overall year. And then on the right-hand side, just noting briefly that similar circumstance with regards to a handful of sectors, most notably information technology, consumer discretionary, and consumer services, really drove market performance over the first 3 quarters of the year. Saw that balance out over Q4 a little bit. But as noted on the column on the far right-hand side of page 13, those 3 segments represented the bulk, if not all, of the market return for the S&P over 2020. And again, our positioning earlier in the year, underweight to those particular sectors, underweight to those respective names, hurt our returns. We had adjusted our position midway through the year to pick up some of that. But we really, our domestic equity returns were essentially hurt early on. And then I'll also note, just from a quality perspective on page 14, it's a very interesting slide. We non-earners and how they performed over the course of the year really impacted market returns. And page 14 just provides a comparison of the Russell indices versus the S&P indices. The S&P indices tend to have a higher quality bias to them, whereas the Russells are a little bit more inclusive and incorporate more names. It's really not uncommon to see a difference year in, year out between the 2 indices, but we saw a pretty dramatic divide between the 2, most notably driven by the lower quality names that are represented in the Russell indices. And so you can see that represented at the large cap category, where the Russell 1000 all inclusive was up a little over just under 21%. The S&P was up a healthy 18.4%. If you exclude those non-earners from the Russell 1000 index, the index was up 15%, or a little over 15%. And the same could be said for the small cap space as well. Healthy return of close to 20% for the Russell 2000. If you exclude the non-earning names out of that index, that drops to just under 10%. So pretty dramatic divide. And again, just given the positioning and the quality bias of a lot of our managers, we did not necessarily participate or have a lot of exposure to some non-earning in companies, in our opinion, that already had lofty valuations. With regards to our convictions going forward, I'll skip to pages 20. A lot of the same positionings that we had over the course of 2020, we've maintained coming into 2021. So asset classes that really we've put in the portfolio to add diversity to the portfolio and kind of help mitigate downside risk, like global infrastructure or real estate, that they really did not help in a market environment like 2020. We do think that over the long term, they will add value and improve our risk return profile for the portfolio. We still have conviction in large cap domestic as well. We've modified our positions within mid and small cap domestic. Our international positioning, we still have an overweight to EM. We still think the prospects for emerging markets in general are very favorable. And on the fixed income side, we've maintained more of an emphasis on credit or spread sectors. And so that position we think will continue to serve us well, especially as we get into a somewhat of unknown territory on the fixed income side, where we're bouncing off the lows and interest rates have started to gradually move higher here. So I know that was a lot of information, but I'm hoping that provides some perspective and insight into the returns that we've enjoyed over the past 12 months or so. And I'd be happy to answer any questions that you may have at this time.
John, this is Kevin. Really talking about the last piece that you were talking about, maintaining our conviction. Have you factored in the recent $1.9 trillion of stimulus that would tend to have an inflationary bias towards it, especially as we see, I mean, it just came out probably a half hour before we got on this call that the city's already figured out how to spend all $293 million that they're going to get, including $11 million on a light show. You tend to see that there's, you know, if people are getting this money from the feds, that's obviously going to have an effect on what interest rates, what our U.S. treasuries are going to be doing. And I don't know what other effects it will have in the market, but has that been factored in yet, or is that too new to really?
No, it's a great question. And the topic of all of the massive amount of fiscal stimulus, the potential impact of reinflation and things of that nature have all been taken into consideration, Kevin, with our positioning. So just a couple of comments. We think, you know, from a broad asset class perspective, we think equities are probably the best hedge against inflationary pressures. At this point in time, we do anticipate, and the Federal Reserve is trying to reinflate the economy in some way, shape, and form. You know, they've historically they had a targeted rate of inflation of 2%. They've now changed that, so it's not necessarily a target, but they've consistently broadcast to the markets that they would be comfortable if inflation were to run above that quote unquote 2% target or a higher range for an extended period of time. And so they through maintaining rates as low as they are and through the massive amount of fiscal stimulus that has been applied, would anticipate, and I think the Fed is hoping for, a reasonable level of inflation to enter the market, and could see that run above 2%, or hoping to see that run above 2% for a while. Our outlook on inflation, we would anticipate seeing some inflation over the next couple of months, but would tend to agree with the Fed's position that will be quote unquote transitory. So the numbers are going to look a little bit wonky, like the year over year numbers are going to look wonky because, you know, starting now, given the pandemic hit this time last year, and so we're not talking about a slow growth environment last year comparing where we are today. We're talking about a no growth environment last year. And so you're going to start to see inflationary numbers tick up, but that should hopefully start to measure out or taper out as we get into the latter portion of this year. And so we don't necessarily think that the inflation will get out of control at this point in time. Our positioning, we're not looking to add tips or commodities or anything of that nature. We think from a positioning perspective, having higher equity allocations probably serve you better or best in a high inflationary environment. But we don't necessarily think we're going to get to a quote unquote high inflationary environment. Does that help? And I would say even on the fixed income side, we are positioned a little bit more aggressively. We do have concerns. You know, we've already seen rates in the 10-year move up quite a bit. We would think that pressures, you know, outside pressures and investors' interest in just searching for yield will help put some downward pressure on longer term interest rates domestically. And so at this point, we think, you know, the long end of the curve has probably run a decent amount and don't anticipate it going much higher. The Fed has obviously kept the short end of the curve pretty anchored tight and will, you know, has indicated they will keep it there for the next couple of years. And so we don't necessarily see too much upward movement, I guess, in longer term rates at this point in time, thinking that investors both domestically and abroad will continue to purchase U.S. Treasury. You know, there's the quality as well as the yield relative to what investors outside the U.S. can get, given negative or zero interest rates outside the U.S. We think that will help maintain longer term rates where they are.
That was very helpful, John. And as you were saying it, it just came to mind some of the previous presentations where we were hearing about negative returns internationally.
Right.
Well,
go ahead, Terry.
okay. With that, I'm going to, for the sake of just brevity here, I'm going to focus on the Bettman portfolio. The two portfolios are largely managed with the same managers, with a couple minor exceptions, and we can certainly hit the what we call the Parks portfolio if you want to take that time. But in regards to Bettman, on page 23, 24, we have the investment policy, and in the conversation that Craig and Jim and John and I had a couple weeks ago, we realized we had made some attempts a couple years ago to get this portfolio on the newer investment policy that the other managers currently are managing by. And I think we hit some stumbling blocks a couple years ago and then did not quite push it through. But Craig and I got back on that in the last 2 weeks. He's going to be able to, I believe, sign that here in the next day or so. And we will be managing the portfolio more similarly with more of a 70, 75, 80% equity allocation. We've been running a bit lower in the 65 range for Bettman. We will leave the Parks money as is, which is it's kind of a different pool of assets, and it's at 60-40, but still under the newer investment policy statement. So we'll be making adjustments to this policy shortly, and you'll see more of a 75 or so percent allocation to equity as we move forward here. With that, I'm going to move into the Bettman portfolio, starting on page, let me see here, I believe that's 27, no, 28. I'm sorry, no, 27. And just to get a feel for this, we had the policy target we'd been running off of was 65. So you can see our equity allocation pretty much in line, a little bit higher. And to John's point, we see a lot of headwinds in fixed income really over the next 10 years or so. We do a capital market assumption recalculation every year to gauge where we think asset class returns are likely to land over a 10-year cycle. And although we see all asset returns probably coming down, we've had really good returns in 4 of the last 5 years. We feel like we've pulled some of those returns forward that may have evened out over time. So we're looking at the S&P 500 at 6.75% type return over the next 10 years, which is quite a bit lower than we would have, I think we were calculating in the 8.5% just a few years ago. So a bit of that return's already been pulled forward. We still like equities. We think they're a better place to be than fixed income, especially with some near-term inflationary. So we will look to overweight that equity sector here in the near term and as we move forward. But this gives you a flavor of where we have been here recently. I'm going to continue to move forward a little bit and get to the performance pages. Let me get to that. that would be I've got it as slide 34, page 23. This gives you the total portfolio performance. And over the last 3 months, we have seen, as John mentioned, a broader participation through mid and small cap. That made our net total portfolio performance 3.9% over the last 3 months. So outpacing the primary, which was the old 65-35 benchmark, which came in around 2.92%. The secondary benchmark we trailed a bit on, but if you look at the 1 year number, that's where you see the underperformance that impacted us, especially from 2020 and the first quarter in particular, and having the higher quality bias in the portfolio. We returned about 16.73%, and that's February to end of February, with the primary bench coming in at 20.61 and the secondary at 22. So, really 300 to 500 basis points underperformance there due to that really large cap growth outperformance in the first quarter. We did make changes to the portfolio, as John said, around the end of June, early July, to capture some of those mega cap, large cap growth names, I should say, to increase exposure there. We always had some, but just not nearly as much as was driving the market. That performance bled into the 3 and 5 year numbers to a large degree. That's something we're going to be working on as we increase the equity allocation in the portfolio. But that's to dig into it a little bit closer. I'm going to really hit page 36 on slide 37. And this is, again, the 12-month review. The 388 basis points that we trailed the primary benchmark, really 28 of that was due to allocation decisions. We had a contributor there being a little more overweight equity to fixed income per the benchmark, but our overweight to REITs and global infrastructure just were not helpful last year. I should say the global infrastructure actually was in the first quarter. It helped on the downside, but when the next 9 months was the market shooting straight up, it was just a significant drag. But our underweight to U.S. mega cap and the FANG sectors throughout the first couple quarters was a primary drag on performance there. From a manager perspective, and this kind of coincides with that mega cap and FANG underweight, our domestic U.S. equity managers, the large caps in particular, just did not have that exposure. They had a quality bias and none of the non-earners in there. I will say our international managers did quite well. That whole sector outperformed from our manager standpoint, as well as our fixed income manager mix outperformed by the end of the year. So that's really the long and short of what drove performance. And similar story in the Parks portfolio, which is a little bit larger than Bettman now. But any questions on performance, and then we'll let you get on to your other items today.
So I guess what I'm hearing you say is that we are looking to make some shifts as far as investments to a little bit more higher base and equities going forward. That sort of fits in with what your comments earlier were about looking forward where you think we should be positioned. Is there anything else that we can do, and perhaps Craig, you could share with us what are the changes that you're making with the investment policy? Is there anything else that we can do to help you and help PNC with managing this?
No, I think the update to the investment policy, and Craig, you can jump in here as well, but that's going to help us, especially over the longer term. Having allocation to equity that is more in line with the other managers should put us, right in a much tighter band with them. I'm sure, there'll be pockets of performance that, we're under and pockets where we're over, but when you're 10, 15% underweight equity compared to others, that's fairly dramatic. So I think that helps a lot. Some of, what we've seen, certainly our positioning was not helpful last year. I think you saw in the last 3 months, 4 months, we've tightened up considerably and doing much better. Hence, that's why while we will increase the overall equity piece of the puzzle, our positioning under that, knowing, maybe increasing our emerging market a little bit, and some tweaks like that as we rebalance the portfolio. But quality names have tended or have shown that they're starting to perform better in the current environment. So that's we're happy with that particular positioning. Craig, I didn't know if you had any other IPS comments you wanted to make.
No, I was just going to state that, yes, for the PNC investment team is getting them on the same page as Fifth Third and US Bank. So their investment policy is going to match what's at those two entities as well. So everybody's on the even playing field.
Craig or Terry, even though maybe the IPSs weren't identical, we don't really have any individual funds that are that far skewed from PNC, do we? Terry, you mentioned that we might be underweighted by 10 or 15 points. I don't know whether we've got any policies that would allow that to happen. But meaning, regardless of what the IPS says, we've all been kind of 65-35, have we not? Now I'll shut up and then I'll follow up with one other question. Craig, we don't have anybody that would allow us to be 80-20 equity and fixed, do we?
Our current IPS does allow a range. So It does allow to go up to 80.
But do any of our other funds, do they reflect that kind of mix?
I would need to go look at their investment. I believe it could be pretty close with US Bank and Fifth Third, but I would have to go back and look.
Well, then that would make sense of what you mentioned earlier, Terry. But I mean, I think it would make sense, obviously, probably for the last 300 or 400 years, if we were heavily, if we were 80-20, which is what I wanted to do here at the Y, and Jim would never let me with my endowment fund. But yeah, if you were more heavily weighted on equities, of course, you'd outperform what we've seen for the last couple of years. But to follow up on the different slant on Jim's question, what are you and John going to do, not just to create better total return than what we've seen by being more heavily skewed to equity, but more in line with the benchmarks, because your benchmarks are going to be stretching as well as you do this.
Yeah, and part of that we actually adjusted about mid-year last year because our largest over underweights were underweights to the FANG stocks. And that had to do with our positioning coming into 2020. We were in the longest expansion in the history of the United States, and it was slowing. So we had rotated to higher quality names, et cetera, and gotten pretty underweight some of those higher growth names. I think moving forward, we'll be a little less aggressive in coming that far off benchmarks. So, I think you'll see us tighten a little bit to benchmarks over time. However, we do want to perform well too. So, if we see opportunity sets out there, the the pandemic was just something we did not foresee coming. I know no one did, and we came out probably a little worse than some of the competitors out there with the way we were positioned. But at the same time, a lot of, I think, correct thinking went into our positioning. And as long as our strategy team's recommendations make sense moving forward, we'll look to implement those. Although if they get very far off benchmark, we're probably not going to stray that far in the future. I guess would be the way I put it.
Yeah, Steve, I would just add to that. I mean, we maintain conviction in our investment process, in the due diligence of our strategy and our portfolio construction and our investment advisory research team. So, you know, we knew when we put the portfolio together that we would have underweights and overweights, in particular, a little bit of lack of exposure to that large cap growth space, just given where we were in the business cycle and our expectations, as Terry mentioned, being closer to the end than the beginning of the business cycle, and where valuations were for those particular companies. And so that did work against us last year. So, I mean, we maintain conviction in some of the asset classes that just did not work last year: global infrastructure, real estate. And we think longer term that they will add value, but we will be more mindful, I guess, of those underlying exposures, I guess, and going forward to ensure that we have good balance for unexpected events that may occur.
Steve, when I look at the performance last statement with the other investment managers, Fifth Third was running at a 76.24, and U.S. Bank was running at a 71.29.
That'll do it. A little bit of it.
Okay, well, if any additional questions, and thank you for those.
Steve, I didn't know if you had another question, or if John, you have anything?
Okay, well, thank you so much for your time today. Apologize if we ran a little bit long, but if you have any follow-up, all right. If you have any follow-up questions, please don't hesitate to forward them through to John and I, and we're happy to get back with you. Kevin, I will find out about really that great question around folks with disabilities and what we're doing there, because it certainly needs to be addressed. So thank you very much.
Thank you, gentlemen.
Thank you, everyone.
Thank you, Terry.
Thank you very much.
Thank you very much.
Okay, well, I do think that we had very productive calls with them. Kay was actually on one call that Craig participated in. So I think the message got through, and we'll see going forward. Clearly, as we just identified, being at a 60-some% equity versus a 70-some% equity will definitely reflect the types of lagging returns that we've seen with PMC. So hopefully that will correct itself going forward here.
Jim, do you know, have we asked them, and really, Steve got onto my root question of the benchmarks, because if I can't say memory serves, because I wasn't involved at that time, but my understanding is we accepted their recommendations for benchmarks.
Yes.
And then fell somewhat materially short of those. I think less so in the past 6 months since you've taken some action that way. But I guess one thing I would be open to, or maybe even in favor of, would be an opportunity to refresh and ratify or edit benchmarks, because then I think we have a unquestioning ability to sort of bring accountability against benchmarks that were, I don't know if anybody remembers why those benchmarks were chosen, but if there were a fresh set of, okay, on March 24th, 2021, we chose this benchmark because X and Y and Z, I think that would position us to have a more certain opportunity to bring accountability should there be an ongoing underperformance that way.
Yeah. And Craig, I think we asked them to provide to us if they had any recommendations for changes. And did you get anything from them, or have they provided anything along that line?
So I actually reached out to Fifth Third as well as US Bank to obtain, just refresh my memory of what the benchmarks were for both those entities and ensuring that they're utilizing what we want them to, the benchmarks. And the good news is what they return is similar benchmark calculations. And that's what I shared with PNC Bank as well. So I can go ahead and forward you what those benchmark calculations are, so you all are aware of it. And then if we want to make adjustments or have recommendations, we can recommend any adjustments to the benchmark.
I think that would be good to do. That way we can see what they're proposing, and perhaps at our next meeting, we can spend some time just drilling down into those and determining what we want to do going forward.
My primary vehicle for assessing performance is comparison to benchmark, and maybe that's short-sighted or maybe it's not, but that's really what I do, because I'm trying to control for other overweighting or underweighting in equity,
Yeah.
fixed incomes or anything. So I lean on that heavily. So having that, not just sort of having a legacy of that, but having a freshly affirmed selection of that, I think would be a positive thing.
And I think, John, you're right that if we've allowed the investment advisors to kind of pick their own benchmarks, and then we're trying to compare investment advisor to investment advisor, and they're saying, well, we're this much relative to our benchmark, it's not really giving us the information that we need to determine who's doing the best job for us. I think we have drilled down a lot on a lot of the things, like being able to get a true net return. Everybody is giving us that disclosure now, and we're not having to search for it. So we've done good, but there's some more that we can do.
Yep.
I would think, and Craig, you should, confirm, but even if the benchmarks are not identical, they're probably pretty darn close in terms of it's going to be 65 to 70% the S&P 500, and then they'll pick some Barclays benchmark for the fixed income. So they might not be identical, but they're not way the heck off. And I think that our concerns have always been twofold, right? Not just how do they compare to US Bank and Ball and Gainer, et cetera, but how do you miss your benchmark by 400 basis points?
Yeah.
And again, this is going to help when you go from 60-40 to 70-30, your total return is going to improve. But are they going to continue to miss the benchmark by 300 or 400 basis points? You remember, Jim, we're kind of in control of some of this yield if we decide that we want to accept more risk. Do you remember when we pressured US Bank, mix it up so that we have more dividend producing stocks? Well, that was so that it freed up more unrestricted yield that we could spend. Meaning, yeah, we probably have got half of the message across to them. We want more total return. Did we get the other half across to them, that we'd like them to be smarter than the four of us?
It's a good point, Steve. And I do think we should put this as our number one agenda item in the next meeting. And if you could circulate those things to us, Craig, I'd appreciate it. The thing that we'll have to keep an eye on, because we do have the outlier with Ball and Gainer in our overall portfolio. So we'll have to sort of keep that in mind as we look at the performance of all of them comparatively as well.
I think you're probably reducing the number of benchmarks increases the quality of information or knowledge that we gain from that information. But I also agree, Jim, Ball and Gainer's whole investing premise is different. And so holding them to a benchmark identical to others probably isn't really
Right.
going to give us any good actionable insights.
Yep. Good. Well, good discussion. And I think this is going to be a positive result going forward as we talk with PNC, and to have gotten Kay's attention because she did personally follow up and got involved, I think is good long term. And I don't think we've bruised any egos along the way, so that's positive as well. Okay, well, why don't we move on? Craig has circulated the meeting minutes from the 27th. John, did you agree with those minutes, or did you have any changes? Or
I did not have any changes, and my apologies again for my absence there.
I hope everything turned out well, and we missed you. But it does, Steve or Kevin, do you have any changes to those?
I think they're fine. I can make a motion to approve.
That's perfect.
Second.
Super, Kevin. Any opposed? Hearing none, we'll approve the minutes. Craig, you circulated a nice schedule for us of results through the February. Is there anything you want to point out to us besides the growth in the raw dollar amounts?
No, one of the things that I do want to look at, even maybe our next meeting, is as we see the markets doing extremely well, we probably want to make I would say a recommendation to the commissioners in the future of dispensing some of those dollars. This could be maybe a May meeting. This way we kind of understand, we do understand by that time how the stimulus dollars are going to be impacting our infrastructure dollars, as well as maybe that frees up additional dollars where we can use commissioner fund dollars for other stuff.
Well, and to follow up, after our last meeting, I did forward to the commissioners, and I thought I copied you on it, Craig, that we were recommending at that time that the commissioners take a look at opportunities for putting some of this money to work. There has been no further action actually taken by the board. However, we are having some very strong conversations about opportunities to move forward with either tackling our deferred maintenance or with some opportunities combining with some money that we will talk about here in a second. But I think, as Craig said, we continue, and I think we all agreed at the last meeting that we do have an opportunity here if we can actually put the dollars to work, meaning we've got the internal wherewithal from a personnel and just infrastructure capability to handle additional projects. We are encouraging the park board, our commissioners, to look for ways to take opportunity of the gains that we've had in these accounts to really put some things to work. I'll put it that way. So I can let you know that we are having a lot of discussions about that. Along that line, we have not approved yet, and perhaps another agenda item for our next meeting, Craig, will be to make a recommendation to the board as far as distributions. And I know last year we did a very conservative 2% and said we would look at opportunities later in the year. We have been extremely busy, I'll put it that way, and we have not completely utilized all the funds that we have available just because of ability to handle all of the projects that we have. But we are looking at some additional hirings that we're looking at to give us a little bit more bandwidth and capacity to get some of these projects done. So I think at the next meeting, we should put on the agenda also recommendation to the commissioners for fiscal year 2022, which starts July 1, as to recommendation for distribution as part of our spending policy. I realize now number 3 was trust review update, and I'll take that on. We have been working with third-party attorneys to look at all of our investments, all of our endowment documents, and we have really made some good progress as far as identifying that we've gone through each one of our funds and identified, is this truly a trust, or is this something that looks like a trust? And we've also found in the whole review process that in some, we've treated them internally as restricted funds, when in fact we have found that they can be used for other parks rather than the primary park that we must take care of first before we could utilize the funds on other parks. So it's been an excellent process. We are a deliverable that we are still waiting for from our attorneys is just a write-up in response to the questions that we provided to them as to is this a private foundation, or is this a public trust, or how do IRS classifications impact our distribution policies? They've looked at all of that for us. And employer identification numbers, we have found that we were a little screwed up on some of our EINs and are in the process of getting those taken care of as well. So it's been a good process. Obviously, it's taken a little bit longer. I would have liked to have had this wrapped up in 30 days, but it takes a little bit longer. So I think we've made some real progress.
I just wanted to add to that, Jim. I think that the attorneys have done an excellent job on this, and it's one of those things that, had been lingering. I know it was a question that you had, Jim, was a question that I had since before I got on the commissioners board, like what exactly were these endowments? And I know that nobody at the city knew. Going through this exercise has definitely been worth it, because we've not only discovered things, but we've now got them in order. We know what we can do when we can do it.
Yeah. And what our intent is once we do get the final written report from the attorneys, is we will write up so that not just Craig, but those that come behind us in either Craig's job or in the commissioner's report, commission board, we will have a clear understanding of each of these, what it is, and have it all documented. And we'll share those obviously with Steve, you and John as well when we get it. But I think it will give us a really good, clean slate with these funds going forward.
One of the questions I would have then, Jim, would be on the funds that are driven by a 5% distribution of the asset value. Is that something that I could provide, like Fifth Third Bank as well as US Bank, the opportunity to distribute those funds while the market is trending upward versus waiting, and potentially if we wait too long, the market could be trending downward by the time they traditionally distribute the 5%, which is usually in June, summertime, June, July, August.
Yeah, obviously, if I'm not mistaken, there was some questions that our attorney had as to, are these truly funds that are going to be bound by that IRS 5%? But clearly, given the market where it is today, I think since we have not cleared that up with them, so to speak, I think I would go ahead and give them the authority, if they are still moving forward with the classification. And guys, these are the ones where they are the trustee, Fifth Third is the trustee. So to change what they have perceived or they have deemed the true IRS category for these, if we disagree with them, there's going to take some time to get this worked out with them. But I think you're correct, Craig. I would give them the okay that if they are still operating on a 5% distribution to go ahead and do it whenever it's available.
That sounds good. Yeah, it'll just hit our books a little earlier versus wait until the middle of the year or the third quarter.
I don't see anything wrong with that.
That kind of brings up another question though, and that is something that you were mentioning earlier, Jim, which is, our recommendation to the board, the investment committee's recommendation to the board as to the percentage to spend in the upcoming year. And so if we've got some of these funds that we have to, let's say we think we should be spending 4%. Let's just pick that. I don't know that would be what we would pick, but let's say we pick that. If we have to spend 5% out of some, does that mean that we're necessarily going to be underspending, to the tune of 3 or 3.5% on some of the other funds?
Gotcha.
Well, you can look at it two ways. One, with the distribution of the ones that are set at 5%, those can be distributed at 5%, but then we can look at it from a spend standpoint to maybe have it at a set rate of 4%. So 1% would just go towards the fund balance.
Well, and that's where the approach that we're taking today is a little bit different now that we have taken what we have deemed to be some excess money in our commissioners fund. And the commissioners fund, as you recall, is the accumulated fund of all the distributions out of our endowment funds. So now we are taking a portion of those and investing them in the market rather than holding them either in a checking account or in a money market fund, gives me a little bit more comfort that we're still earning something on those. So we could, it is twofold. The issue is, I think at this point in time, it makes a whole lot of sense to distribute 5% out of these funds, given the balances and given where we are in the market. But we've also got to ramp up at the park board to be able to put that money to use so that it's not, we're not having an opportunity loss here of not having those funds invested. At least we do have a vehicle where we can invest some of that in the PNC accounts to make some money. So I think we will, at the next meeting, we'll make a decision as far as a recommendation to distribute from the primary funds. And I can assure you, we're looking at, from the park board side as well, how can we ramp up to get those funds spent on now that we have the big thing that we have in front of us now is this document that we received, and we haven't gotten the final report from them yet, but it is a third-party consultant that has gone to every one of our facilities and has broken down our facilities by infrastructure, meaning pavilions versus special structures, buildings, whatever it is, all the way down to electrical needs in some cases, to ponds, reflecting ponds that we have in some, and then also the roadways. A lot of our parks are in really, really strong need of doing some road work. which is the park board responsibility. So we now have a document that's almost completed that tells us park by park by park type of investment that we have, and whether that, for example, a pavilion, whether it's in poor condition, fair position, condition, or good condition. So we also have a priority order, so to speak, of where we should be putting our money. So again, we will be focusing on that here definitely in the next year.
I have a question if I can on the timing matter. Craig, were you anticipating, because you have your fiscal year ends June 30, yes?
Yes.
So you wouldn't be changing the fiscal year into which those funds were distributed. And I'm imagining the trusts are governed on a calendar year, not a fiscal year, or do they correspond to our year?
They're a calendar year.
So that could, I don't think it really creates a problem. It's just something to bear in mind about when they're needing to make that 5%, if they are in fact needing to make that 5% distribution, when they calculate that too.
Yeah, and they are looking at, as you're correct, at a calendar year. So
Okay.
they will be distributing in 2021 an amount based on historical or earnings through the 12/30/20.
Okay.
21/20, yeah.
Got it.
But for accounting purposes, again, Craig can, whether we record it or not, I mean, it could be from a budgetary standpoint, we just have to be clear that those funds were for budget year, fiscal year 22.
That's correct. Yeah, and that's
It
something what
just,
we do.
Yeah, just makes Craig make sure he keeps track of which year they're in. But you're correct, John. The last item we had is discuss outstanding items and park projects. One thing, it's very timely, and you may have seen reports today in the press that Cincinnati will be receiving potentially $291 million of stimulus money as part of the latest stimulus bill from the federal government. And the city has been working with all of its entities as well as others of what are potential uses of those funds. And we saw this morning for the first time a potential breakdown of distribution. And I was really pleased to see that. I think Parks, we did make a very strong request. And I think if you look in total, and I'm not sure the exact number, but I think we're looking at close to a $15 million number of funds that will come to the park board, either to compensate for lost revenue based on some of our parks and things, and Crone Conservatory particularly. We have been negatively impacted because of having Crone Conservatory closed. So I think all told, this money, we still, it's very, very early to know exactly how much we're going to get. And then also what's the timing as far as when that money needs to be spent by, and to ensure that the items that we have identified, and we're pretty comfortable about this one, the things that we have identified clearly qualify for these funds. So it sort of goes back to the discussion we were having earlier today, is that there are funds available to do some significant work in the parks. And now we are challenged as a park board to be able to have the capacity and resources to get that done. So we will be moving forward with that very quickly. One of the things that we are looking at is sort of partnering with the Parks Foundation as well to utilize funding that the Parks Foundation has available that is earmarked for specific parks. And then looking at our park board funds that are also restricted potentially for specific parks, and looking how we can equitably spend money across the whole city in all 52 of our neighborhoods. So that's something that we're going to be putting a plan together and working as well with the foundation for how we can touch every one of our 52 neighborhoods in Cincinnati. Some major projects and some with just hitting on this list of deferred maintenance that we have, just to ensure that we are spreading that money around the city.
That's good, Jim. Thank you.
And we are obviously some of the major projects. We are work on the banks. The new music venue and park is moving very, very quickly. Even though I'm not sure that we will have an opening for concert season this summer, I think the park itself will be ready for opening. We are looking for ways of finishing that park. As you know, we did some bare bones investments to get the park opened initially. But Park Foundation continues to raise funds to do what we call phase 2 and put a lot of the extra amenities into place. So we're looking at partnering with the foundation and doing that, potentially with some of this stimulus money that we just got. So that project is moving forward. We've got some major things going on at Inwood Park in Mount Auburn. And then we've got some real plans. Mount Airy is going to see some significant investments over the next few months. The Cora group, the biking group, continues to work on new trails. We are putting together plans for a biking skills center there for teaching biking skills to kids or adults. And that will be at a section in Mount Airy. And then just looking across the whole system, as far as additional trails, either in multi-purpose trails, biking and walking, or in connectivity of trails from one park to another. Those are focus points for us as well. So the good news is we've got a lot of opportunities for doing some significant work in the parks. And now the pressure's on us to be able to be at a place where we've got the capacity to do it. Any other questions that you guys might have, or comments, or anything at all?
I have an easy one. Craig, in addition to that endowment fund summary, did you send out the one that shows the 1 and 3 and 5 year returns? And maybe I just missed it, or we only do that on a quarterly basis?
Yes, that is a quarterly report.
Okay. I'd like it 6 times a year, please. So.
Kevin, do you have anything else for us?
I don't. I think this is great. I think that for John and Steve, especially the outside report from the third party that's telling us the real condition of our parks it's a game changer and will help us really put some of this endowment money to use rather than us just continuing to accumulate more money. That's not our business. We're not in the business of accumulating money. We want our parks to be better, but we never really knew where to put it because we kept always getting the same statement from Parks Administration, which was, we've got $55 million of deferred maintenance in our parks. And it's like, well, what is that? And we found out when Jim and I got on the park board that it was a straight line depreciation of capital assets and didn't really take into consideration the actual condition of some of those assets. Now we have the condition of the assets. Craig's got the finances transparently open enough that we know where all of the different little pockets of money are and what they can be spent on. We now know what the endowment monies can be spent on. So it's not just we're spending this money here just because we can spend this money here. It's we're spending this money in this location because, one, we've got money that can be spent in this location, but two, there's a real need. There's something that's in poor condition in this park that needs to be spent.
And it sounds like it's more of a zero basis approach to that than I never knew the origin of that number. So that's a straight line depreciation. Fascinating. That's a vacuum number right there. So interesting. Yeah. It was a sticky number. Everybody knew that number, but its correlation to useful capital assessments is tenuous at best.
It was good for an elevator speech, John, but
exactly.
But no, as Steve said, this group has done an incredible job going out and actually looking at every park and providing a lot of data to us and assessing particularly the condition. So we now have, rather than a future spending requirement, we do know what is truly deferred maintenance versus future capital needs. So it is a great roadmap for us.
Yeah.
And that's where,
go ahead. Me personally, Jim, it's identified a lot of opportunities of where we can be working closer with the Recreation Commission.
Yeah.
Where, you know, Cincinnati being one of the few places that has a parks department and a recreation department instead of parks and recreation. This is what everybody talks about, shared services, but yet we continue to have our own little silos. This gives us a really good basis for starting to attack that monster of shared services.
Yeah.
Great.
So it's a positive time, and to have been fortunate enough to have funds that are now flowing to the parks on a one-time basis gives us an opportunity to knock some of those things out that may have suffered for a while. So it's a positive time for us. Okay, well, let's talk about, Craig, how soon do we need to meet again? Obviously, if we think about, we've got a park board meeting in April, third week of April. If we should shoot for the having this prior to the May meeting of the park board, should we look at March, April, either the end of April or maybe the first or second week of May?
How's everybody's calendar look? Yeah, because I'm looking at like April 28th or May 5th. So, and it would be Wednesday from 3 to 5, but if there's another day needed, you can look at that.
I'm available either day.
May 5th would be better for me. I've got meetings all around that.
Why don't we?
And May 5th is Cinco de Mayo, so we could have margaritas afterwards.
We
afterwards.
Can toast. If that works for everybody, why don't we pencil in then May the 5th, and we'll do 3 o'clock again. And then Craig, if you would, obviously, and sometime in April, go ahead and send out the quarterly report whenever you get Steve's report done for the first quarter. And then if you would, at the same time, if you would go ahead and just get out the minutes at that time as well, so we don't wait till the next meeting for that.
That sounds good. And did we want any presenters at that meeting? Because we've been...
let's not do presenters at the next meeting. Let's focus on the benchmarks. Let's focus on where we are from a park board as far as budget for this coming year so that we can make a recommendation on distribution. And hopefully by then as well, maybe we will have the final written reports from our attorney to just at least flip through so everybody has it, what we found out, the final report from them as well.
Sounds good.
Great.
Yeah, Jim, relative to that distribution thing again, and as a former park commissioner, I can say this now, it's a little hard to make a recommendation on what we should be distributing when what we previously distributed continues to accumulate in there and not be spent, because it doesn't, we can distribute whatever you want, but if it's just sitting in another investment account that's working under the same parameters that the money's already in, it's not really doing us any good.
And Kevin or Jim, clarify that for me. Is that how it has always worked? We have a policy. It's a distribution policy, not a return to operations policy. So it ends up in that it ends up in the commissioner's fund, but we distribute some of that, don't we? Or is it just it's not entirely accumulating there?
So I'll be very, very transparent with you. Over the years, the intent is that we establish a commissioner's budget to spend the money that we have coming out of our endowments and the monies that we receive, like from the Parks Foundation, and monies that we know is coming in. We typically have put a budget together that pretty well matches revenue, and we come up with the expenses for that year of how we're going to spend it. We have fallen behind as far as keeping up with spending, and that's why over time this commissioner's fund continues to grow, and we've got today over $7 million in the commissioner's fund, which if you talk with the individual commissioners, we would love to spend it. Now, a portion of it we do hold back because we do use part of our commissioner's fund budget to supplement operations from a personnel standpoint. If there are things that we fall short from city allocations to us, sometimes we depend on our commissioner's fund to supplement that to hit the budget. But over time, Steve, the objective has always been that we find ways to spend the monies that we have available.
We just haven't been doing it in the last few years. We haven't been spending capital money that we've gotten from the city in the years that it's been done.
So hence the discussions that are really going on, and it becomes even more evident to us that we need more capacity to be able to spend the funds that are available now with the stimulus money as well. So the impetus is on us as a park board to get the capacity there to be able to put these funds to work.
Got it.
Okay, anything else from anybody? Well, I want to thank you guys again for taking the time and spending it with us and looking at this stuff. I truly appreciate it. And
welcome.
you will get info from us, and then see you on March the Cinco de Mayo.
May
May 5th.
Mayo, sorry.
All right. Thank you very much.
All right, thanks
Bye,
all.
everybody.
Guys.
Everybody.
Bye now.
Bye.